FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. It's 10/15/18. Well, gold seems to be back from the dead, up nearly $30 last Thursday, down a couple bucks Friday, and now we're getting a follow-up confirmation rally right now as we speak. John Rubino's on with me. It's 12:28. Silver at $14.70 the ounce, both up pretty smartly on a Monday morning. Hey, you better get the plunge protection team out there. That's our only hope. Anyways, as always, join the show. Email us, kl@kerrylutz.com. Well, John Rubino is with us, dollarcollapse.com. If you haven't gone to his site yet, make sure you go there now. It's well worth your while. If you're listening on YouTube, don't forget, click that ridiculous subscribe button, the bell ringer, the share, and subscribe, as they say in the parlance of YouTube. So we got a couple of questions to answer, John. But first, happy Monday.
Happy Monday, Kerry.
Yeah, things are starting to happen here. So first is our good friend, and it's not his real name, so I can say it. Well, we'll just use his first name, Jesse. So my question for John is: the recent rise in U.S. Treasuries due to the Fed increasing the FFR, federal funds rate, or is it a premonition of an imminent dollar decrease? What happens many times when the stock market falls? MSM tells us it's because of a too hot economy. If that is true, why didn't rates increase throughout the last 9 years? This is why we listen to your channel. We know the MSM is for those that don't question. Does anybody even listen to Kramer anymore? LOL, thanks, Jesse. Well, so is it real or is it Memorex? I mean, that's the question. John, is it getting ready for a rapid drop in the dollar, or is something else afoot here?
Well, there's a lot of moving parts to today's economy. Some of them are real, some of them are fake, and some of them are in between. So it makes it hard to attribute cause to any specific thing that happens out there because you've got all this stuff going on. But my take on interest rates is that the government has been artificially suppressing the inflation rate for all of this cycle and for the previous few cycles by not counting financial asset prices as inflation. In other words, stocks going up or home prices going up don't count in the cost of living. So they don't think of it as inflation, but it actually belongs there. I mean, if you're an investor and the price of stocks go up, the cost of investing went up for you, right? If
Absolutely.
You're a would-be homeowner and the price of houses go up, then your costs go up maybe dramatically. So if you add those things back in, we've had inflation all along. But lately, asset price inflation has been joined by inflation in things that the Fed is willing to admit is actual increase in the cost of living. Wages have been going up, and wage inflation is terrifying to the Fed, and the prices of a lot of other things have been creeping up to the Fed's target of 2%, which means that even the official view of inflation is now bumping up against the level at which some action usually has to be taken. And the Fed has been raising interest rates. So that's spooked the financial markets. And people have been bailing out of bonds. They've also been bailing out of stocks just very recently, although they were buying the heck out of stocks previous to that. So we're seeing financial market turmoil because it looks like we're bumping up against limits that require the government to tighten. Now, it's possible that the government won't let this go on very far. And that's probably one of the reasons why gold and silver are going up these last few days, because the gold market might be looking ahead to the Fed saying, did we say we were going to tighten 2 more times? We're not going to do that anymore. We'll just stop where we are. And then a little while after that saying, you know what, we need to cut rates. In other words, the the cycle turns down, the Fed has to switch from tight to ease, and we see another round of extremely low interest rates and quantitative easing, et cetera, out there on the horizon. So that's the end game for all of this. And right now, what's happening is the first signs of indecision on the part of the financial markets and the traders, mostly about how long it'll take the Fed to switch gears. and that's unknowable. But it's the biggest deal in all of this, because if they let it go on for a while, we could see a huge bear market in stocks. Yep. And if they switch gears right away, then we'll see the opposite. Stocks will go up, and who knows what bonds will do. But real assets will probably respond dramatically to a big increase in Fed money creation, et cetera, et cetera.
Mm-hmm. I agree. And, a lot of people, I was just talking with the guys at Starbucks this morning, can the market keep going up? But it's priced for perfection. The stock, the tax cuts in there and all that. But, the thing that moves stocks more than anything else is flow of funds. When funds are flowing into the market, then it's going to be going up. And when funds flow out, it is going to go down. And that's really the most important factor. But it's very difficult for you, the average investor, to really figure this out. So, and what makes them flow in and what makes them flow out? Certainly, traditionally, higher rates led to less money in the stock market, led to declines in the stock market. But in this instance, with the machines and everything else, I don't know what to think here, John. I really don't.
Well, Kerry, here's one aspect of the flow of funds idea. For the past few years, the government has pushed interest rates down to unnaturally low levels, and in a lot of cases below the dividend of a lot of big companies. So if you're IBM, for instance, and you're paying a 2.5% dividend, I'm guessing here, but that's probably a reasonable number. IBM can borrow money at 1%.
Yes.
And buy back their stock. That's a cash flow positive activity. They don't have to pay the dividends on the stocks that they take out of circulation. So they make money by borrowing money to buy back their stock. Plus the earnings per share goes up, which leads to bigger year-end bonuses for the executives. So it's a win-win for those guys, at least in the short run.
Yeah.
And that's happened across the board in the equity markets and in corporate America. And in this past year, we cut taxes in a way that made it economic for companies to bring cash that they've been hoarding overseas back here. And a lot of that flowed into equities. So that's what's generated this epic bull market in equities for the past few years. Now, if interest rates go up above the dividend yield of the S&P 500, that takes away a lot of the incentive for companies to keep buying back stocks. So when the cash repatriation story starts to peter out, and I don't know when that'll be because there's still a lot of cash that they just brought back, but eventually they run out of that cash, and if interest rates are too high to make sense in terms of cash flow to buy back stock, then you'll see that big impetus for rising stock prices go away. And then the question becomes, will it be replaced by governments buying equities? And at some point it will be, but there might be a gap in between there that would be really bad for stock prices.
Yeah, definitely could be. And, that's right. Traditionally, stock buybacks were not such a big part of the overall market dynamics, and they weren't really figured into that flow of funds into the market. Really, what the flow of funds was always considering was flows, institutional flows, and individual investor flows into the market. But the buybacks have had two effects, John. Number one, it has decreased the overall supply of shares available to John Q. public, as well as the funds. And number two is it's basically set up a situation where more money is chasing less shares, so that increases in demand for shares have way more effect than they used to have. And this has really sent the market topsy-turvy. It's not every stock doing it, but certainly the S&P 100. And the other thing is the declining availability of companies on the public markets, somewhere around 40 some odd percent, 46, 49%. Danielle Park told me the number, but it's close to half the number of companies that used to be traded publicly are not. And that's due to Sarbanes-Oxley, that's due to bankruptcies, although that's the least of it, that's due to mergers, acquisitions, and private equity and leveraged buyouts, which are the same thing, right? So
FSN Radio. It's all about what's next.
Egypt is on the verge, once again, becoming a world-renowned gold producer. The Golden Age is being rediscovered. For millennia, ancient Egyptian kingdoms prospered from unparalleled riches. Pharaohs built their empires and flaunted their abundant wealth that was made possible by the country's resource-rich gold deposits. Despite this rich history, modern Egypt remains one of the most underdeveloped gold mining countries in the world. Aton Resources is at the center of the modern Egyptian mining world, diligently working both as the only public exploration company in Egypt today and as the advocate for mining reform with the Egyptian government. However, those that arrive early like Aton will reap the best rewards. Aton's discovery of the legendary Lost Mountain of Gold at Rubino and its current aggressive drilling program there could potentially reap those rewards. Aton Resources is focused on its 100% owned Abu Marawat concession in the Arabian-Nubian Shield, located 200 kilometers north of Centamin Sakari's world-class gold mine. Aton possesses first-mover advantage in the underfollowed jurisdiction of Egypt, which is currently undergoing mining reform. To stay on top of Aton's latest drill results and news, go to atonresources.com. Aton trades on the TSX-V under the ticker AAN and on the OTC under the ticker ANLBF.
The Financial Survival Network. It's all about what's next.
So these are big numbers we're talking about here, John, that really have distorted and changed the overall complexion of the market.
Sounds like a perpetual motion machine, the way you describe it, huh, Kerry? You borrow money, you buy back your stock, the stock goes up, that allows you to borrow more money and buy, and that has been what's happening. We're doing a rolling leveraged buyout of the U.S. corporate economy right now.
Right.
So assuming it's not a perpetual motion machine that can go on forever, what's the limiting factor? And that is the debt that you have to take on to do it. You've got to borrow money to do this stuff.
Yeah, that's debt is the mother's milk of modern finance, right?
Yeah, and it's also the poison at some point.
Well, that too.
Because as you borrow more and more money, that money has to be, or that debt has to be rolled over at some point. And you have to pay whatever the prevailing rate is for your next round of borrowing. So as interest rates go up, this whole thing gets more expensive. And there's a point at which the cost of debt turns the process that's going on now from a perpetual motion machine to a negative feedback loop. And rising cost of debt makes corporate earnings go down, blows up a lot of balance sheets, and causes stock prices to go down. And you get kind of a death spiral. So we're headed for something like that as interest rates go up. And we don't know what number sets this off. But there is a number on, for instance, the 10-year Treasury bond yield that blows up the stock market and crushes the corporate America. So is it 3.5%? Is it 7%? We don't know. But a lot of people are speculating now. And the speculation seems to be coalescing around 4 or 5%. Which is historically normal. That's what the 10-year Treasury bond has yielded most of the time before this latest era of experimentation. So it's not a hard number to envision getting to. And if it turns out to be the thing that blows up the economy, then that gives us something to watch, right? As interest rates go up, we're getting closer to Armageddon for the current financially driven society that we've created. And your time is getting shorter, and you should be preparing. So that this is really helpful. If we have a scenario that plays out this way, then we've got a limited time in which we need to get our act together financially and be prepared for an interest rate driven collapse of the current leverage speculating community.
Yeah, well, it is a dicey situation, that's for sure. So, hey, going back to gold here. So everybody's been telling us we are charter members of the Stop Clock Society. Gold's going to go up eventually. Gold's going to go up eventually. but it obviously had to take a hit before it could go up, right?
Well, this has been a long, brutal bear market in precious metals. And it went on longer than I thought it would. And it's taken gold and silver to lower levels than I expected. And it's crushed the mining stocks, the gold and silver miners. So it's created the conditions in which, if gold and silver turn around a bit, you'll see the miners take off, and you'll see a lot of hot money flow into precious metals, because that's really the only undervalued sector that's left out there, right? Tech stocks are way up. The banks have come off their 2008, 2009 lows, and they're many multiples of those prices. And there's really not a sector that you can point to and say, oh, well, this is where value investing should take place, other than precious metals and the miners. So one of the upsides, and I know this is cold comfort, but one of the upsides of an unusually long bear market is that things get really cheap. And when they start bouncing off their bottom, they tend to put up big percentage gains. And so we're seeing out there now, with gold and silver making nice moves, not spectacular moves yet, nothing compared to what's going to come when the Fed announces the next round of QE, but still pretty good moves. And you're seeing a lot of the junior miners make moves that are multiples of what gold and silver are making now. So all of a sudden, the precious metals space seems happening. It seems like it's a fun place to be. And that's been a long time in coming, and there's no guarantee that it stays that way. But right now, it's fun to watch. And there's some money being made out there. So there are animal spirits in the precious metal space that are increasingly absent in, for instance, big tech, where Amazon and Netflix are kind of getting whacked lately. So it's nice to see it. I don't know how long it lasts. And the one thing you can hold on to is that a sustained version of this is coming. We don't know if this is it, but when it starts, it'll look like this. And the question is, will this continue in the right direction for very much longer? And I think there's a chance that it does, because there's a lot of anxiety out there. Carrie, we haven't even talked about the two big anxiety-producing stories that happened just lately. And one is Saudi Arabia, where they apparently murdered a reporter in a really public way. They didn't know it was public, but he was broadcasting with his Apple Watch. And now everybody in the world feels compelled to sanction Saudi Arabia in some way. And they're saying, well, you know what? The oil markets are not going to like this. In other words, they're threatening to use oil as a retaliatory weapon. And there was just an article today with a headline, $400 oil is not out of the question if the U.S. sanctions Saudi Arabia. And that's spooky to the markets, right? That's terrifying. And then maybe an even bigger story is Germany, where Angela Merkel, who has been this rock at the center of Europe for the last decade.
The cause of all evil in Europe, right?
Well, a lot of what she's doing is now coming home to roost. She increased immigration over the objections of a lot of other Europeans, and now other governments are being elected that are anti-immigration, which is a dismissal of her policies really publicly and really blatantly. And now in Bavaria, her coalition partner just got crushed. I mean, they're still the biggest vote getter, but they lost a lot of ground to both the Green Party, the far left, and the far right party. So the vote in Bavaria is bifurcating, and the middle is losing ground. And Merkel might be out of office in the not too distant future if this keeps up. And then what happens if Germany, the most stable piece of the European project, is destabilized by, for instance, a government with an Italian bent, somebody who's kind of anti-Euro and anti-immigration getting in there. And that's a really big deal, because the euro is the number 2 currency in the world, and the Eurozone is the biggest single currency block in the world. And there are trillions of dollars of euro bonds out there. So that's a huge deal if it happens. And it's looking more and more possible now. So you add those two things up, Saudi Arabia and the U.S. conflicting that affects oil, and then Europe no longer an afterthought. All of a sudden Europe becomes a destabilizing story instead of a stabilizing one, and the world just got a lot more scary. People I think are longing for the days of just an emerging market crisis. When only Turkey was blowing up.
Yeah, well, it's all pretty interesting. And it's going to affect you whether you like it or not. So it might be a good idea to take some measures here. My personal opinion on the market, and it's personal and not actionable. It's just my gut feel is this thing's going to continue this insanity, because I just remember the saying that the markets can remain irrational much longer than you can remain solvent. And if it was that easy and the conventional wisdom was always right, then everybody would be rich in the market, but most people lose. So you can pretty much figure it's going to do the opposite of what you expect it to until it doesn't. And it's just a question of time, John. It's just timing. It's all it is.
Well, fundamentals win out in the end.
In the end, we're all dead.
Exactly.
In the end, we're all dead.
You have no idea where that end is until after the fact. That's a hindsight idea, the end of a cycle.
Yes.
You only know it by looking back for a year and saying, on December 17th, that's when it all ended. And so we don't know what this means in terms of year ahead timing. But it's clear that a lot of imbalances are building up, and those imbalances, when they work themselves out, will be pretty catastrophic for the conventional wisdom today.
Yes, they will. That's for sure. We just can't know the timing. I mean, we would have thought it would have happened 10 years ago, John. Let's face it. I mean, that's really what it comes down to. I sure did. But what you always have to remember, what I've learned, the main thing I've learned, aside from like how to lose money, which I was already pretty good at, but what I've learned is about currencies, that currencies aren't a unit of measure of value per se. What they really are systems economic systems to conduct trade, to carry out transactions, to measure, all right? They're measurement systems first and foremost. Every numerical system is a measurement system. And that when the world gets used to one system, it's got to take something like unbelievably cataclysmic to get them to stop using that system and to switch to another one. And you know what? Evidently, 08 and 09 wasn't enough, John. I mean, yes, there's all this de-dollarization talk and all that stuff. You and I both know all about it. But so far, guess what? It hasn't happened. And as the emerging markets get more and more dangerous, there will be a flight back to the dollar. I know it sounds amazing. It sounds like it can't happen, but it's going to happen, Sean. And I think you're going to be shocked. Before this whole thing blows up, the dollar is going to be looking pretty darn good, pretty attractive, like it has for the past 2 years, John. That's what I've learned from all of my trials and tribulations over the last 7 years.
Yeah, that's one of the implications of the Europe story. If something happens in Germany that destabilizes the Eurozone, that's bad for them. But the money that's terrified and leaving the Eurozone has to go somewhere. And some of it will come here. Maybe a lot of it will come here. So yeah, it's kind of counterintuitive, but trouble in the world actually helps the U.S. dollar in the short run. Only in the short run, though. But you could see a year in which the dollar is the pillar of the global financial system, while nothing else is even close. And that's probably good for U.S. equity prices. It's probably bad for gold. But it also creates an even bigger imbalance that when it's worked out will be way better for precious metals than what would have happened otherwise. So, it's a 6 of one, half dozen of the other. You just got to be patient and things will work out, but we can't know when they're going to work out.
Okay, all I'm saying is that the trend in motion, especially when you deal with trading systems and currencies, they continue on until they cannot any longer. That's my only point here. And to think you can never know that to think that the demise of the dollar is just around the corner. It's always around the corner. And that's what you have to understand. Because to do otherwise is to invite real disaster into your personal portfolio, into your life. Hey, we got to wrap it up for now, John. I know you're in a hurry. Just check out John's site, dollarcollapse.com. Sign up for his newsletter. Sign up for ours. I'll have one going out the next day or so. financialsurvivalnetwork.com. Email us and join the discussion and be a part of the show. The email address, kl@kerrylutz.com, Twitter feed @KerryLutz, and Facebook page, Financial Survival Network. Next week, John, we are going to have video. I promise you that. And guys, just quick for YouTube, click subscribe, like, share. Okay? John, we'll talk to you next week.
Okay, Kerry. See ya.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.